Good afternoon. Welcome to Midcap Radar. I'm Sonal Bhutra. With me is Vivek Iyer. And look at the move on the Nifty in just last couple of minutes. 97 points higher on the Nifty. Big boys are supporting the moves that we're seeing here. The metal index, Reliance Industries. I know this is a show about mid-caps, but just look at the move.
You're right. It's the big boys that's actually dragging the markets higher, and the Bank Nifty continues to support. Yesterday, 2% higher. Today, they continue to support. Quite a lot lined up. Quite a few managements on the show as well. So, very interesting show lined up ahead. Let's start off with the top headlines. Stocks seesaw in a range trading session ahead of F&O expiry. Metals, along with oil and gas, are the big gainers, even as auto and pharma drag. Mid-caps outperform.
Minda and CE Infosystems gain after Goldman Sachs initiates with a coverage on the stock with a buy rating, a target of 1,350 and 2,800 rupees respectively. Says Minda is well positioned for growth in India's auto components industry, and adds CE Infosystems is well poised to benefit from leadership position in automotive navigation.
Power Finance Corporation sells in trade after the company's board approves a 15,000 crore loan to the Shapoorji Pallonji Group. IIFL Finance flags off concerns, says the move simply transfers the risk from high-yield bond investors to PFC.
PNB Housing Finance slides over 4.5% after 5.2% equity changes hands. Sources tell CNBC-TV18 Asia Opportunities and General Atlantic Singapore Fund are the likely buyers. Key to notice that the deal has taken place before the lock-in period for the previous block deal ended. Okay, all right, those are the top headlines, but we have to take a look at what the Nifty is doing. Almost 100-point higher at the day's high, and it is supported by a number of factors. The metals index, that is surging 2.5% higher there. We do have individual components as well, which are doing really well in trade today. So the likes of JSW Steel, there's Reliance Industries, there is ICICI Bank, some of these consumption names as well, which are supporting the moves that we are seeing on the Nifty right now. And as Vivek was pointing out earlier, banks too continue their support. So that index is up 0.8%. And in last couple of trading sessions, we've just spoken about how mid-caps have outperformed. But today, the last few minutes of changes that we've seen in the Nifty is definitely noticeable.
You're absolutely right. Last 15-20 minutes is where the actual surge has come in. You mentioned metals, one more name over there. Vedanta today is doing very, very well. But I'm sure, Hormaz has a lot more names in his list. This is our special segment, Midcap Movers, where Hormaz has been looking at the screen to take us through all the midcaps that are doing well in the session.
Credit where it's due, right? The big boys lending support to the market, final 2 hours of the weekly expiry session. So it'll be interesting to see whether these gains hold or not at higher levels. But starting off with the gainers from the broader markets as they continue to do well. And the fertilizer stocks are the ones that are in the spotlight yet again today. Fact, another 20% upper circuit now at 1100 almost. Chambal Fertilizers up 17%. RCF is in a 20% circuit after a block deal that took place recently. And Deepak Fertilizers also trading with gains of 15%. So gains across the board anywhere between 15 to 20% in the fertilizer pack. The other segment that is doing very well is the chemical space, and amine stocks are there leading the pack there. Balaji Amines, Alkyl Amines up 6% each. Deepak Nitrite is up almost 6%. Naveen Fluorine also seeing gains of close to 4.5%. As you were mentioning, metals, they are the ones that are shining in today's session. Vedanta, after the management interview, is at the highest point of the day now, almost 6% higher. NMDC, Hindustan Zinc, Nalco, all of them having a good day in today's trading session. Volume buzzers, some of the stocks that are doing well on the back of volumes, and CE Infosystems on the back of the Goldman Sachs note, 20% circuit there. Mahindra Holidays, Clean Science, all of them seeing good gains on the back of very strong volumes as well. And lastly, some underperformers in today's trading session, where PNB Housing finds a mention after the block deal, almost 5% lower there. PFC, with regards to some concerns over the loan, the Global Health and Home First Finance also not having a good day at the office in today's session. Back to you.
Okay, but there's such a big difference in the number of gainers versus the losers today, right? So that's the kind of market that we are in today. Hormaz, thank you so much for joining us as always and taking us through the movers in the broader markets as well. Let's talk about individual stocks now. The stock on our radar is OfferSpace Solutions. The company reported a good set of fourth quarterly numbers. This is the company's first set of earnings post-listing. Amit Ramani, the chairman and MD of the company, is joining us now to take a few questions on the earnings and the outlook going forward as well. Amit, good afternoon. Thank you so much for joining us today. The street definitely likes the profit that you have reported in Q4. And in terms of losses, they've narrowed in FY24 as well. Is this something that they can expect going forward as well? Profits going ahead? And what is the growth outlook that you have in terms of revenues and margins in FY25?
Sure. So thank you for having me on the program. I think, clearly turning profitable in the fourth quarter was, a focus area for us. And I think the profitability for FY25 will continue. I wouldn't want to give specific guidance on the numbers, but it will continue. In terms of the revenue growth, we are looking at about 30% growth between FY24 to FY25. And in terms of margin improvement, at the EBITDA level, we believe that we can have a margin improvement of about 1.5% from the current 31%.
Okay, so you're expecting FY25 to end, with margins of 1.5% higher. But let's come to, the main part of the business, which is the occupancy rate. FY24 exit occupancy stood at 71%. What has been the trend in Q1 FY25? What has been the new number of seats that you've onboarded, and will that skew the ratio as we head into FY25?
So, see, occupancy is a build-up scenario, right? Clearly, at the blended level, which is centers gone live, let's say, few days ago to from the inception, is at 71%. But if you look at the centers that are 12 months or more of vintage, we stand at 84%. So this has been consistent for the past few years, in fact. And we believe that this level of occupancy, which will be in the range of 70 to 72% at a blended level, and 84 to 85% at 12-month more vintage centers, will continue. Last year, we added about 28,000 seats and about 40 odd centers. This year, the plan is to add about 40,000 additional seats. And I say that with a lot of confidence because we exited March 24 at 95,000 seats, right? And we have another 15,000 seats that are under fit out currently, and another 15,000 odd seats that we have an advanced stage letter of intent. So we believe out of the 40,000 for FY25, we have full visibility currently of about 30,000 out of that 40. So we are very, very confident of our seat capacity growth.
Okay. So, you are talking about occupancies on a blended levels to remain at the similar levels at FY24, but you will be adding a lot more seats in FY25. Would it come at higher rentals as well, Amit? What would the rental picture look like in that case?
So see, I think I talked about my model a little bit on the show before as well. So we work about 66% of our portfolio is in partnership with the landlord, where we are either doing a revenue share or a profit share. So that mitigates our risk, where a majority of the new capital comes from our landlord, makes us capital light. And second, the landlord is taking the risk with me. So clearly from that partnership model, we believe that that ratio of about 66 odd % will continue in FY25. About 35% is what we call straight lease, which is typically in strategic markets and where we already have the demand from the customer. So those obviously are very customer-centric driven decisions, and we will take obviously the right calls. Currently, our portfolio, about 90% is in tier 1, about 10% is in tier 2 cities. But if I look at FY24, in terms of our growth, 85% came from tier 1 and about 15% came from tier 2 cities. So that ratio will continue in that direction.
Understood. Avis, also give us a sense. Now, 66% is from the managed aggregation model. While, of course, that goes ahead and mitigates risk to a large extent, we also understand that that would also mean slightly lower margins for you against the straight lease model. Could you give us a sense of, what will be the margin differential, and going forward, what do you think is the optimum mix for you?
Yeah. So going forward, the optimum mix will stay in this zone. Because if you look at FY21, we were 46% managed aggregation and the rest was straight lease. Today, we are at about 66%, and going forward, we will maintain the same ratio. We make a bit lower margin when it comes to clearly managed aggregation. Typically, these are at the center level, between 22 to 24%, whereas in a straight lease, this would be somewhere around 30%, right? So at a blended level, we are doing at the center level, we are doing a margin of about 25 to 26%. And that will continue because the ratio will continue in the same zone. So the margin as well will continue in the same direction.
So, Amit, when you talk about that 150 basis points improvement in margins, what are you factoring in? What is the reason that will cause that margin improvement?
So one is operating leverage. Our fixed costs or our indirect costs are not going to go linear with our revenue growth, right? So we'll get operating leverage. Second is operating efficiency. Obviously large, and we are now established in almost all cities, and those cities are all obviously generating returns for us. And third is obviously the occupancy itself, right? I think we believe we have some ability to improve that as well. Even though we are adding a lot of additional seats, we believe our sales engine is able to get in front of the occupancy a couple of points higher, and that those three reasons, operating leverage, efficiency, and occupancy, are going to drive that 1.5% improvement.
Amit, give us a sense. Number one, we understand that you'll have two agreements, one with the owner or the landlord, and the other one will be with your client. How often do both of these agreements get revised? Typically, how does it work? What will be the percentage of increase you will see when these agreements are revised? And do you expect this also to be a driver for growth, especially when client revisions come about?
So with our landlords, typically the tenure is 5 to 9 years. And with our customers, the tenure can range from a day to 5 years, right? But today, our blended tenure is about 33 months. Our locked-in tenure with the customer is 24 months. So clearly from that standpoint, we probably are able to have obviously stability with our landlords for 5 to 9 years. And here we have some clear visibility of demand of almost just shy of 3 years. So from that perspective, in every contract with our customers, in long-term contracts, let's say anywhere between 2 years to 5 years, we have a 4 to 5% escalation built into the contract. When it comes to some of the smaller tenures, we have typically a 6 to 8% built into in terms of our escalation. When it comes to our landlords, we are looking at 15% typically. If it's a straight rental, if there's no minimum guarantee, or if there is minimum guarantee, the escalations don't really kick in. But if there is a straight lease, that increases 15% every 3 years. So which would be average about 4.6% year on year.
Okay. All right. Amit, thank you so much for joining us today and explaining that in detail as well. The street likes the numbers, the stock is high by 4%, and the management is sounding very positive as well. That's the word on OfferSpace Solutions. We'll slip into a short break. When we come back, we'll be joined by the management of Insecticides India. IMD has revised monsoon forecast for June to below normal from normal. We'll try and understand the demand trends and the sowing patterns as well. Stay tuned.
Welcome back to Midcap Radar. Well, as promised, we had told you about how we have a management lined up. Just remember, the Indian Meteorological Department in its latest update said rainfall between June 1st to June 18th has been 20% below normal. They also revised the monsoon forecast for June to below normal from normal. To discuss how this will impact initial sowing, we have Rajesh Agarwal, Managing Director at Insecticides India, joining us. Good afternoon, Mr. Agarwal. Hope you're doing well, and thank you so much for joining us here. First up, give us a sense of how sowing patterns has been across the country. The rainfall has been well below what the expectations were initially.
The rainfall is able to hit the markets 2-3 days before the prescribed dates. So the farmer has started sowing in many parts of the country. Like if we start from south, Tamil Nadu had a great rainfall, followed by Andhra Pradesh. Also Karnataka is reasonable, and Maharashtra and MP, it is catching up now. So are the sowing patterns actually sowing has started in these areas, particularly for the dry crops. They are preparing the fields, and also sowing for cotton is on, sowing for other crops is on. And similarly, we look at east, the preparation is on, and in north also. So overall, I would say that yes, there has been some trend shift, like in north, paddy short duration is increased, and a lot of sowing has already started little early before time. And even cotton and other crops have started. Cotton, though there is a decline in north and also in the central part of the country, but cotton in south is going up. So overall, if we look at the scenario, then it looks good, and people are quite hopeful because we believe that the rain situation should show the improvement in the last week of June and or early July. So the swing is on and field preparation is on in the full way.
Okay, so Mr. Agrawal, has it in any way impacted volumes for you, especially in central India, because their deficit has been to the tune of 31%. How much of your revenue or share of volumes comes from there, because that's also the grain producing area, major grain producing area? Do you think that is something which could impact volumes, or it is in line with what you had earlier expected?
It is little early actually to comment on that, but yes, there is very high demand because this is the time when the shopkeepers prepare themselves for the herbicide usage, and they have started making the buying for the herbicides, and the demand is in full swing. The day it rains, the market movement is going to start. So they are prepared, even if it get delayed by 1 week or 10 days, it hardly matters because immediately on rains, they will start taking the material or selling the material.
So, Mr. Agrawal, what you mentioned is that right now maybe it's still a little too early to predict the course of the rainfall and maybe say that this particular season could be a little slower than usual. We'll wait and watch as that progresses. But now moving outside,
this is going to I don't think this is going to be a slow season because at this moment the trades mood looks to be a little buoyant because there is good expectation from this season, and if we look at the price trends also, because there are international shortages, also there are issues with the international freight. So there is some tightness in the market already, and that is one reason. The trade channel is also vacant, I would say. So they are keen to store the material now, and immediately on the first rain, the sale is going to start. So I'm very, very hopeful, and I'm very positive about this.
Okay, all right. Mr. Agrawal, this is about what's happening domestically. Even globally, we are talking about heat waves and, some of the cropping patterns changing. How big is exports as a part of your revenues? Which are the countries that you export to? And is that portfolio seeing some pressure?
For us, international business is a small market at the moment. Just it contributes 5% to our total business. But yes, there is growth possibility in future. At the moment, there are various issues. The currency issue is the biggest issue. The transportation issue is the second issue because the freight rate has increased on the international level to a big extent. So that is also impacting. So otherwise, market is going to pick up on the on that side also because there is expectation that during this season, the old inventories which were there in Europe, America, and some other parts of the world, they are going to dilute, and the new demand is expected to come. We do our major business in Middle East, Africa, and ASEAN countries, and we also export small quantities to Europe and America.
Mr. Agrawal, just towards the end, what we want to understand is you had guided for FY25, you had guided for double-digit top-line growth. Q4, you saw quite a bit of strong margin expansion on the back of low raw material prices. Now, Q1, what are you seeing the raw material prices trend at, and do you maintain your double-digit top-line growth?
Yeah, definitely we maintain our targets which are given by us. The markets have bottomed out, and the prices have started little going up due to the demand-supply differences. So I believe that the margins also are going to be better in this year, and from the Q1 itself, they will be visible.
Okay, all right. So margins will improve, pricing is better, and you're not seeing any demand headwinds for now, despite the delay that we have been seeing in monsoons. Mr. Agrawal, thank you so much for joining us today. That's the word coming in from Insecticides India. The stock is doing well in trade today, up around 3%. Let's slip into another break. When we come back, we'll get you more on the markets and stock-specific action, so stay tuned for that.
Welcome back to Midcap Radar. Now, we'd like to shine the focus on one more stock that's doing quite well in the session today, and that is Reliance Enterprises. Reliance Enterprises is in focus. This is on the back of the fact that overnight, SEBI has gone ahead and given or issued a 12-page show cause notice to both Reliance Enterprises board as well as the chairperson Rashmi Saluja. What is it that SEBI is asking them to do? SEBI has directed the Reliance board to go ahead and give an undertaking that they will be filing applications for the open offer with all of the regulators. So which are the three regulators where Religare has to go ahead and file an application in order for the open offer from the Berman family to proceed? The first one is RBI, the second one is IRDAI, given the fact that Religare houses an insurance arm as well, and thirdly, SEBI itself. So far, there has been quite a lot of to and fro between the Religare board and SEBI, but this particular document by SEBI clearly goes ahead and unequivocally states that they would have to go ahead and proceed with the IPO. Remember, in September 2023, the Berman family had made an open offer to acquire up to 26% stake in the company at 235 rupees a share. Religare too has responded to this particular development that they say, as per SEBI's advisory, the company will apply for the fit and proper status of the acquirers for the open offer to the concerned regulators, including the RBI. But that's all the time we have on this edition of Midcap Radar, Mutual Fund Corner, when we return.